The final installment of this finance transformation series will conclude with customer value. Customer value is traditionally associated with the order-to-cash finance and accounting value stream and covers the entire customer fulfillment process, from signing the contract to collecting cash for services rendered. While traditional order-to-cash focuses on manufacturing order fulfillment, this is an outdated manufacturing model. Professional services companies have multiplied exponentially in the last quarter century, and the service-based economy is now the global standard, with time materials billing illustrating the commonly accepted payment terms. With the modern service-based model in mind, this value stream can be broken down into three distinct phases: contract approval and work authorization, project setup and costing allocation, and invoicing and cash collection. Now, let's take a closer look at these three phases. Contract approval is more than just affixing a signature on a piece of paper. There are various workflow management software packages that incorporate compliance controls and assurances that the contract is a legally binding document. Once this has been secured, the downstream value chain kicks off. Remember that customers can be either internal or external, with internal customers represented by legal entities separate than the entity initiating the work. The former internal cost transfer is commonly referred to as intercompany, which is a set of accounting procedures designed to eliminate transactions between subsidiaries. Project setup and costing allocation is perhaps the most involved phase of the value chain, and subsequently requires the most attention. Typical costing models oscillate between fixed fee and time materials billing models, and employ an enterprise resource planning system to manage the parameters for time entry and billable client work. In recent years, data quality initiatives have played a role in identifying reporting irregularities and other data anomalies. These anomalies are even more prevalent among intercompany transactions. An October 2014 study by Deloitte on intercompany transactions revealed that 30% of all respondents noted significant out-of-balance accounting positions that require frequent use of plugs to balance. In other words, intercompany transactions frequently have inaccurate and/or incomplete cost allocations, which can create financial statement presentation issues. Invoicing and cash collection appear to be the most straightforward, but are often the most overlooked parts of the customer value stream. It is more than just sending a piece of paper with an amount and due date on it. There needs to be a robust operating model in place to ensure these events occur effortlessly. Many organizations implement and develop shared service centers of excellence to both fulfill these needs and also minimize cost structure. As part of this model, these employees are trained through carefully designed standard operating procedures and measured by selective key performance indicators, or KPIs, that provide benchmarks for continuous improvement. Most importantly, striking this balance between a cost-effective staffing solution and the optimal target operating model is a difficult but necessary one. Having trouble with your intercompany balances or can't find the right operating model for your organization? Please contact us at FT2M to have a conversation about how we can help.